When investors look at very short-term movements,
Right.
a small drop gives them pain and agony. A small rise gives them happiness. So they keep going through this emotional roller coaster on short-term movements. It is difficult to book losses because you have to admit that you were wrong.
Right.
It is easier to book profits. So typically people who watch the screen too much, they tend to book profits early in what they have got right and keep the losers in the portfolio hoping that they will come back to break even soon. This is called a disposition effect, and it does affect the quality of the portfolio ultimately that the investors end up with. The second research done by Terence O'Dean was about all that glitters, as he called it. That people tend to pick up those stocks or those companies which are attention grabbing. So if that particular day a company is in the news, if there is a sharp movement in volumes and price, people tend to take notice of that, and then they are more likely to be chosen in the portfolio than the ones which have not made any noise on that day. This again leads to problems that a good company may be lying quietly and a good investment may be there for the longer term, lying quietly, but people don't look at. And it is quite possible that when you're going for these attention grabbing or glamour stocks, you may end up chasing the performance. You may end up investing in these companies when much of their run is already done with. So that's also a problem when you are only focused on noise and attention grabbing companies.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully.